My name is Mark Sullivan, and I'm a Vice President with FMS. I would like to introduce the first part of the presentation to Chris Cooley with my HR concierge. Chris, take it away.
Great, thanks, Mark, and I appreciate everyone being here today. Today what we'll do is we will talk about the measurement period analysis. We'll talk about reporting that's available through your FMS payroll system. We'll talk a little bit about minimum value and also the affordability ceiling. So we'll go ahead and get started. One thing I did want to do is one of the big talking points in our last seminar was regarding the King versus Burwell case, and the Supreme Court did make the final ruling, as you may be aware, in last month. And based upon that ruling, there are no changes to the Affordable Care Act. So basically, it was a non-issue once the ruling came in. So that is either good news or bad news, depending on how you're looking at that. I also want to take just a second to talk about employers that have under 50 FTE. You know, a lot of times those employers look at the ACA as not relating to them, and it doesn't in many ways, but it also will affect them. One thing is you're not required to provide insurance under the employer mandate, and you're also not required to perform the reporting at the end of the year unless you do sponsor a self-insured plan. There are some requirements there. So you do get the benefit of not having to offer the insurance, and for most of those companies not have to perform that reporting. However, there are some aspects that you do have to comply with, and we can't go through all of them today, but one that I did particularly want to point out is the employer health care arrangements. So one thing that's common with a lot of small businesses is you know, a business may not offer an insurance plan, and so what they'll do is they will go to an employee and say, well, I'll give you $100 a month. That'll offset your cost to go to Blue Cross Blue Shield, United, whoever it may be, and get an individual policy. That's common practice. Today, if you do that, and I believe it was effective June 30th, but today if you do that, there is a $100 per day fine per employee, per applicable employee. So you really want to kind of look at that, look at how it's structured, look at how it's documented before entering into one of those arrangements. So the first thing we want to talk about is the measurement period. And the measurement period, it's a designated period, and it is used to determine if your seasonal or variable employees are full-time and eligible to get health care coverage. One thing that's very important is the classification of full-time, part-time, variable, and seasonal. As you can imagine, a lot of people, what they'll do, or what a lot of business owners have said they're going to do, is basically if you have an hourly employee, they're going to say they're variable. And there are some benefits to that to the employer, but that's something that the government is really going to look at. So you want to make sure that when you make those determinations, that if you are hiring somebody that is scheduled for 30, 35 hours a week, they're truly not variable. You want to go ahead and offer those guys insurance on the front end. Truly variable employees, they don't have a typical schedule, and it could be they get 15 hours one week and 40 hours the next. So you want to make sure of that. The measurement period can be between 3 and 12 months, so that's at your option. Once you make that determination, you do need to be consistent with that. And this is important. The measurement period is very important, because if you don't do it and you don't do it correctly, there are 2 penalties that you could face. The first one is if you do not offer 70% of your employees that are eligible for insurance. In 2015, the mark is 70%. Then there's what they call the penalty A, which is a penalty of $2,000 per FTE. So that obviously that can add up. There's also a second penalty called penalty B, where if any of those individuals that you did not offer coverage to goes to the exchange and gets a subsidy, there's a $3,000 penalty for that. Now, these penalties are based on monthly calculations, so that $2,000 and $3,000 are annual numbers. So if you do see where you have an error and you correct that later in the year, you can mitigate some of that. But it's a fairly complex calculation, but those are the penalties that you can face. Measurement periods can differ on versus different types of employees. So if they're collectively bargained, not collectively bargained, if they're salary versus hourly, depending on different states. So you can create those measurement periods that make the most sense for your business. There's two types of measurement periods. There's the standard measurement period, which if you think about it, that is for your established employees that have been there for essentially a 12-month period. You also have an initial measurement period. That is the measurement period that you utilize for new employees. So what you do is they are on a different cycle or a different period than your employees that have been there for over 12 months. There are multiple ways to calculate when you go through your measurement period and you're determining if someone is a full-time equivalent or not, or full-time employee or not. There are multiple ways to calculate that. You can either use a monthly calculation or a look-back calculation. In your industry, most people, 99% or more, are going to use the look-back. Basically what that means is an individual, you're going to look back that period, 3 months to 12 months, which typically it's going to be 12 months, to determine if they have worked on average 30 hours a week. And that's going to be because of the turnover and the way the schedules work. That's typically the way that your industry will do that. Just to give you an idea of how it works for a standard measurement period, for the first year, so what you will do is you'll do a measurement period, and this can be this does not have to be calendar, even though that's how I show it on the screen. You can do this in other time periods. But what you'll do is for those 12 months, that's your standard measurement period, is you will take that, at the end of that period, you'll perform your calculations to determine who has met that 30-hour per week or 1,560 hours for that 12-month period. You'll do that calculation, and you'll have an administrative period after that, which that administrative period can last up to 90 days. That's at your discretion. And during that administrative period, you'll make those calculations. You'll get everything prepared for to offer that employee. You'll have them sign the document, sign up or enroll. And at the end of the administrative period, you'll fall into a stability period. And what that stability period says is, for that period, that employee is locked in for insurance. And that stability period is typically equal to the length of time of the measurement period. So for 12 months, even if that employee goes below 30 hours per week, they still get to maintain their insurance. And then you basically start this process over again next year. So that's the way that measurement period works. The initial measurement period.
Hey, Chris.
Yes.
This is John, because I want to bring that up, is the period of time where the stability period, where someone, let's say John, has offered insurance based on the previous look-back period, and then going forward, obviously, if for whatever reason, I stopped working so many hours, that's where the affordability piece can really bite you hard. So you might speak, when you get to the part about the safe harbors, you might speak to that and hearken back to that.
Yeah. Okay, definitely. So on the initial measurement period, it's the same concept, but what will happen is those employees that are hired within a month, you'll have an initial measurement period that goes 12 months from the date of hire or from the month of hire, and then you'll go through the whole process again. And what happens is, once you go through that initial measurement period, then you have your administrative period and a stability period. At the end of that initial stability period, you will just fall into the bucket with everybody else. So it'll transition to where they go into the standard measurement period. And I know that all of that, it sounds convoluted, and it is. The measurement period is not an easy calculation. It's somewhat complex, and there's a lot of administration to it as far as ensuring that these initial measurement periods are done appropriately and timely, and those people are offered insurance. You have to do provide a insurance plan that is affordable and also has a minimum value. And if you don't provide that, then what can happen is you can be subject to one of those penalties that I spoke about before, the penalty A and the penalty B. Minimum value says that the plan must cover at least 60% of the total allowed cost of benefits that are expected to be incurred under the plan. It's complex. It's probably not a calculation that you'll want to do. So what I would suggest is that you work with your insurance carrier, and what they can do is help make sure that you have a plan that meets that minimum value requirement. Also, one thing to make sure of, or that is an option, is you can have multiple plans. So you can have a low-level plan that meets the minimum value proposition, and then also have a what I would call a better plan, if you will, if an employee so chooses to get that plan. So you can have multiple plans, but you have to have one, but they all have to meet the minimum value requirement. From an affordability standpoint, employee insurance, it cannot be more than 9.56% of wages. And there's several ways we'll talk about where you calculate that. Non-compliance, and you can go back into that penalty B that we talked about before, which is $3,000, and that $3,000 will change. That's an indexed amount, so every year there's an inflationary factor to that. So I believe the next year it's going to be $3,120. So that number will continue to grow. The safe harbors, as far as the affordability calculation, are you can use the W-2, you can use a rate of pay, or you could use a federal poverty line. The W-2, essentially what you do is you take your box 1, it's very simple, take your box 1, multiply it times 9.56%, and that's the most that an individual can pay for insurance. The problem is the timing of the W-2. A lot of times it comes later than you would typically do that calculation. And the other issue is box 1 is after pre-tax deductions. So if they're getting money taken out for 401ks and all those kind of things, that comes out of that calculation. That is not, those amounts are not included in the number that you're calculating from. So it's a lower number. Another one is rate of pay. This is what most people are going to use. It's easy, it's predictable, it's very good with hourly workers. And what you will do is, from a rate of pay, it's very simple. It's the rate. So if they make $8 an hour, it's times 130 hours times 0.956%. Okay, and that is what they can pay. Now, if their hours fluctuate, then that rate of pay, that 9.56%, is static at that rate of pay times 130 times 9.56%. So this is a good measure. This is what most people are going to use, and what I would suggest using. The third one is the federal poverty line. Essentially what you do is you set your insurance at 9.56% of the federal poverty, which is roughly a little over $11,000. So you would take 9.56% of that $11,000, divide it by 12, and which comes out to around $90. So you set every employee to where they pay no more than $90 per month, and at that point, regardless of the hours, regardless of rate of pays, regardless of any of those things, you get the credit at that 9.56%. I'm sorry, the credit at that number. The problem is it's expensive, because obviously you would have people that would pay more than that, that would not meet that poverty line, that would pay more than that $90 per month. So that is my part. One thing I did want to mention that I failed to before, if you are under 50, one thing is look at common ownership. We have found a lot of companies, typically owners of small businesses are owners in multiple small businesses. And we have found a lot of companies will look at an entity and say, well, I only have 15 employees, that doesn't matter. However, they don't take into account that that owner also owns 3 other businesses. And when you aggregate those, it comes up to over 50 full-time equivalents. So if you do have under 50 and you do have owners that own multiple entities, you really need to look at that common ownership calculation to make sure that you don't fall within that. Okay, and I will pass this to you, John.
Great, thank you. So as we spoke about in the last webinar, from a standpoint of FMS and as being a payroll provider, we certainly have a responsibility to provide tools to our clients, to our people that get paid under our payroll system, clients that use that payroll system. And we have we put together a toolkit for that. I really think about it in three segments. First of all, is we built a tool that's a PPACA reporting tool, and it's designed to help you track the hours worked and affordability within the look back period that you've chosen. There's a bit of setup to do with it, and we'll go through that in a second. Secondly, like any software package, we have a query tool that lays over top of our ledger, of our payroll system, of our AP, etc. And we can use that to custom design some reporting, which I'll show an example of one we've done recently. And then lastly, of course, you can use just your normal payroll information. The main features that you have to worry about to determine affordability is to the point, and I'm being covering some same ground that Chris did, but you've got to make sure that you determine who is eligible for insurance, and we have to make sure that we offer those employees affordable insurance. And one thing that gets a bit lost in the affordability thing is if John Klein works for FMS and I choose to insure my entire family under my insurance plan, affordability is not predicated on the cost of that family insurance. It's predicated on the cost of individual insurance. So we built our tool within the system to say, all right, here's what you have deducted from John's paycheck, my paycheck, for health insurance. But we've also built it to where you can say, okay, what is the individual, the lowest cost individual plan that also meets some minimum requirements. So clearly, we have to make sure that we identify every employee that works over 30 hours. As Chris said, this year, Chris, I think it's 75% we have to make sure we offer insurance to. But after this year, it pops to 95, so not a lot of room for error after 2015. We have to calculate the average hours for our employees, and we have to then be able to calculate their affordability. And we built our tools to do just that. When you set up the PPACA reporting tool within our system, certainly there are elements that have to be provided in terms of calculating that. The vast majority of this is already in our system, and I say this to say this because to the point Chris made earlier, for combination entities, maybe Jane Doe has ownership in 4 companies, and maybe none of those meets the requirement to report as an ALE individually, but they do meet it on an aggregated basis. We can help with that. We can, if we can get the appropriate amount of data, we can certainly set that up and help. I've had these calls several times, and include the other entities that do not necessarily use FMS payroll, but we can capture data and put it in our system and report on those on your behalf. As you can see here, the healthcare reports, once it's set up, we can put it in, and you can run it for any date range that you want. You can run it for yourself. You can include full-time. You can exclude full-time. You can include salary. You can exclude it. The ceiling factor is completely adjustable based on what you want to do. I have some clients that set it a little bit lower to give themselves some cushion, but you can absolutely, by identifying the appropriate factors, what we call pay codes and deduction codes, within this reporting tool, you can say, okay, I want you to include these pay codes, and I want you to include these deduction codes to help you understand the Section 125 deductions to help you derive at box 1, and that will absolutely help you calculate the affordability factor. This is an example of that we put in that kicks out of that system, an automated system. And I'm not a sales guy, so this isn't a sales pitch. Everybody that uses our our payroll system, this tool is available to you. There is no extra cost. It just has to be set up and run. If you're a BPO client, talk to your accountant. If you're payroll only, give myself or one of our payroll team a call. But this is available today for each of you, and there is no cost for that. What we're looking at now is I have a couple store clients back west of where I'm at who said, those tools are great, but I really need something a little more usable, a little more friendly for us to use. And so we developed pulling from multiple tables and, frankly, combining a couple of reports. We spent a few hours and developed what we call an Empower. Empower for us simply means it's a query tool. This is actual data. Obviously, I changed the names to protect the innocent, but this is actual payroll data. You can see where I highlighted in yellow. There are some affordability issues on a week-to-week basis. Chris, one thing I would ask you, and I apologize for putting you on the spot. We didn't rehearse this. If John Klein works for Grocer X, and I work there through July the 16th, and in total I was affordable, but for the last month maybe I wasn't because maybe the employer was, manipulating the weekly deduction. How is that affordability calculated? Is it per payroll? Is it per month? Is it aggregate?
What you would do is you'd look at it on an aggregate level. So if someone if they make $8 an hour, you do that calculation we spoke about before, 8 times 130 times 9.56%.
Mm-hmm.
Kind of take that to a monthly, and that's your number for the year.
So if in June I was, because I do have several employees that are saying, I'm going to go in once or twice a year and adjust it. Either I won't withhold for a couple of weeks or I'll make it less. If in June, let's say I wasn't affordable, but July I was, do I have a problem?
As long as you're meeting that rate of pay, that 130 times your that's your threshold for the stability period.
Okay. So if you stay under the safe harbor, you're golden.
Right.
Okay. Thank you. So this is an actual report again. If you have a desire to have this done, if you're BPO, call your accountant, call me, email me. I'm JONC@FMS Solutions. Payroll only, get a hold of our payroll team. A lot of things we can do. I'm fond of saying if you want to know how much a person in green Crocs makes, if you capture that characteristic, I can report it back to you. As I said, customer reporting can be designed to assist you in managing PPACA. The prior report was an actual report for payroll ended last week. And the typical disclaimer, this presentation is absolutely not meant as legal advice. Chris and I both want to make sure that everybody's aware that this is a combination of your HR team, your HR professionals, your payroll provider, which is us, and, of course, your health insurance providers/brokers. So, Chris, I'll let you finish up here.
Okay, thanks, John. One thing I did want to mention, we do have on July 30th at 2 o'clock Eastern, we do have the third part of this series, which will go through the reporting, which is the 1094C and the 1095C. If you think about those forms, effectively they are as W-2s and W-3s are to wages, the 1094 and the 1095 are to insurance. So that is an area where clients and prospects that we've talked with, that's an area of concern, and there are a lot of questions around that. So we do invite everybody back for that one, because I think that one is one that certainly everybody's gonna need to look at or consider.